We love having Mike here with us. The Federal
love being
Reserve,
here.
we love talking about that. They raised that key interest rate 0.25% in February. Mike Giordano, with financial advisor with Williams Wealth Management, telling me that they're likely to kind of keep going up. They're not going to slow down. So we want to talk about how tough it is to navigate the cost of borrowing today. Mortgage rates are at their highest for 2023. And so people are looking at buying big ticket items like cars and houses and maybe boats or redoing. What are things that we need to consider if we're in the market for something big like that?
Yeah, well, first of all, these interest rates are going up simply because inflation's been coming down, but it hasn't come down enough, and it's gotten a little sticky, and so the expectation is the Federal Reserve is going to have to hike interest rates even more than expected. So what the markets do is, in anticipation of the Fed actually doing that, they start raising rates, and that's why mortgage rates that were in the 7s, went down to low 6s, have now shot up to the upper 6s, and so as you know, interest rates are financial gravity, so as interest rates go up, it just starts pushing all other assets down, and in relation to our conversation, it makes the cost of the money more expensive.
So there is a direct correlation between what the Fed is charging for money and what we're going to have to pay, but not necessarily. I don't see mortgages go up by exactly the same amount that the Fed raises rates.
Right. The mechanics are basically when the market's anticipating it, the rates start moving. So it doesn't even matter if the Fed's actually done it. They're moving in anticipation.
It's anticipation, not the facts.
Right. But at the end of the day, you still have to consider the fact that, the basics apply. Don't spend more than a third of your money on debt payments. So if your household makes $120,000 a year, that's
net or gross?
You can look at gross.
Okay.
You can look at the gross number, but basically, if you have $120,000 coming in a year, that's $10,000 a month. So keep your debt payments at under $3,300 a month.
Okay, and so when you're looking at the cost of the house, do you then also figure in what your interest rate is going to be?
Absolutely. So the bank, when they're pre-approving you for a mortgage or a car loan or whatnot, they're basically saying you can afford this much of a monthly payment. So they might pre-approve you for a $500,000 mortgage, but if all of a sudden interest rates go up, they come back to you and they say, hey, we're not giving you $500,000, we're only going to give you $450,000. So that's a really good principle. Bake in a little bit of flexibility. So if you're pre-approved for $500,000, try to find a house where you only need to take out $450,000. So even if the rates keep floating up, the numbers are still going to work. The bank's still going to give you their money.
I love that. You make all of this stuff make sense all the time.
We try.
Mike Giordano with Williams Wealth Management, thank you so much.
You bet.
We'll be right back.